Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories within corporate filings. Today, we're diving deep into the latest report from the NTAM Treasury Assets Fund. And let me tell you, it's a tale of what looks like rock-solid stability, but sometimes even the steadiest ships can encounter unexpected waves. Before we dive in, if you love getting the real scoop on companies directly from their official documents, smash that subscribe button. And hey, we've built an awesome community over on Discord to keep the conversation going, with the link right there in the description. Let's get into it. This filing is essentially a yearly checkup for the NTAM Treasury Assets Fund, part of the Advisors Investment Trust. Think of it as the fund's report card showing us exactly what it has been up to over the past year, which ended the 30th of September 2025. Right off the bat, they give us a snapshot of expenses. For a hypothetical $10,000 investment, the costs for the NTAM Treasury Assets Fund were a mere $10. That is 0.10%. In the world of investments, that is incredibly low, suggesting this fund is very cost efficient. Now, let's talk numbers, the real meat and potatoes of this report. The fund's net assets, which is basically the total value of everything the fund owns minus its debts, stands at a hefty $5,791,608,000. That's a lot of money. The report also shows they hold 76 different investments. And get this, the total net advisory fees paid were around $4,419,000. While that sounds like a lot when you consider the massive asset base, it's quite reasonable. This next part is crucial to understanding how the fund manages risk. They show us how their money is spread out. A whopping 81.4% of their net assets are invested in US Treasury obligations. That means they are primarily betting on the US government's ability to pay its debts. This is generally considered one of the safest types of investments out there. Then, we see 20% allocated to repurchase agreements. These are short-term loans, often backed by government securities, used to manage cash flow and earn a little extra interest. The combination of Treasury obligations and repurchase agreements paints a picture of a very conservative investment strategy, focused on safety and liquidity. Moving into the detailed financial statements, we see the schedule of investments. This lists out every single holding. As we saw in the diversification breakdown, US Treasury bills make up a significant portion, about 60.4%. You can see a long list of these bills, with varying interest rates and maturity dates. For example, there is a US Treasury bill maturing on the 7th of October 2025, with a 3.59% interest rate. Valued at almost $100 million, they have many more, some maturing in late 2025 and into 2026. Then we have US Treasury floating rate notes making up 16% of the portfolio. What is interesting about these is that their interest rates adjust. For instance, one note has a rate that floats based on the US Treasury 3 month bill rate plus a margin. These notes are also spread out with maturity dates extending into 2027. There are also US Treasury notes making up 5% of the portfolio. These are like slightly longer term government debt instruments. And as we noted earlier, a substantial 20% is in repurchase agreements. The schedule details various repurchase agreements with counterparties like Banco Bilbao Vizcaya and Citigroup Global Markets, Inc. These agreements are short term, typically maturing just a day after they were entered into, which is standard practice for managing daily cash needs and earning interest. The collateral for these agreements is usually highly secure, like US Treasury notes themselves, which provides an extra layer of safety. So when you add it all up, the total investments come to 101.4% of net assets. This slide over allocation is normal, and often accounted for by how net assets are calculated versus the total value of investments held at a given moment. The cost of these investments was over $5,873,000,000. Then there are net other assets and liabilities, which in this case is a negative 1.4%, totaling about $81,811,000. This likely accounts for things like accrued interest income, expenses payable, and other short-term items. Looking at the statement of assets and liabilities, it confirms the fund's substantial holdings. Investments at amortized cost, which is a way of valuing these debt securities over time, is almost $4.7 billion. Repurchase agreements at cost are over $1.1 billion. Total assets are nearly $5.9 billion. On the liability side, we see things like securities purchased payable, distributions payable to shareholders, and various fees totaling around $89,830,000. This leaves us with the net assets, which, as we saw, are just shy of $5.8 billion. The net asset value per S-share is exactly $1. This is very common for money market funds, as they aim to maintain a stable net asset value. The statement of operations tells us about the fund's income and expenses for the year. The interest income alone was a massive $255,738,000. That's a huge amount of earnings from their investments. Operating expenses are broken down, with investment advisory fees being the largest at over $6 million. Accounting and administration fees came in at over $800,000. After accounting for reductions by the advisor, which is where the advisor helps lower expenses, the net expenses were about $5,865,000. This results in a net investment income of $249,873,000. They also had a small net realized gain from investment transactions of $61,000. All in all, the change in net assets resulting from operations for the year was over $249 million. The statements of changes in net assets show how the fund's net assets have evolved. For the year ended the 30th of September 2025, net investment income was over $249 million and net realized gains were $61,000, leading to a total change from operations of over $249 million. They paid out dividends from distributable earnings of nearly $250 million. Capital transactions show a significant amount of activity. Proceeds from the sale of shares were over $15 billion, while shares redeemed amounted to over $15 billion. After accounting for shares issued in reinvestment of dividends, the net change in net assets from these capital transactions was about $68,876,000. This brings the total change in net assets for the year to around $68,937,000, increasing the fund's net assets from over $5,722,000,000 at the beginning of the year to over $5,791,000,000 at the end. When you compare this to the prior year, 2024, where there was a net decrease in assets from capital transactions of over $3 billion. This year shows a very healthy turnaround. Now, the financial highlights provide a more condensed view over several years. For the year ended the 30th of September 2025, the net asset value per S-share remained at $1. The total return for the year was 4.43%. In 2024, the total return was even higher at 5.40%. The ratio of net expenses to average net assets stayed at 0.10% for both 2025 and 2024, reinforcing that ultra-low-cost structure. The ratio of net investment income to average net assets was 4.34% in 2025, down slightly from 5.27% in 2024. This reflects the interest rate environment and the fund's holdings. The notes to the financial statements provide important context. They explain that investments are recorded at amortized cost, which approximates fair value. This is standard for short-term, high-quality debt instruments. When looking at investment valuation, it is notable that all of the fund's investments, totaling over $5,873,000,000, are categorized as level 2 inputs. This means their value is determined using observable market data, like interest rates and credit risks of similar securities, rather than unobservable subjective inputs. This further solidifies the fund's conservative and transparent valuation approach. The section on repurchase agreements details the fund's use of these instruments for cash management. They emphasize that the collateral held is required to equal or exceed the value of the agreement, and the fund is subject to credit risk only if the counterparty fails and the collateral value drops. This part clarifies the relationships with affiliated companies. Northern Trust Investments, Inc. is the investment advisor, earning a fee based on a percentage of net assets. The Northern Trust Company acts as administrator, custodian, and fund accounting agent. These relationships are common in the fund industry and are designed to streamline operations. The advisor has also contractually agreed to limit total annual fund operating expenses, which is a significant benefit for investors, capping them at 0.10% of average daily net assets. This contract is set to renew annually. Under other risks, they mention general market conditions, economic and political factors, changes in interest rates, and lack of liquidity in bond markets as potential impacts on the fund's value or yield. While the fund's holdings are very safe, no investment is entirely without risk, especially in highly volatile economic periods. The fund intends to qualify as a regulated investment company, meaning it distributes most of its income and gains to shareholders, avoiding corporate-level taxes. This is a standard structure for mutual funds. The report from Deloitte and Touch LLP confirms that the financial statements are presented fairly in all material respects in accordance with accounting principles generally accepted in the United States. They've been auditing Northern Trust investment companies since 2002, which suggests a long-standing and stable relationship. Finally, the signatures of the principal officers confirm the accuracy of the reporting. So, what's the story here? The NTAM Treasury Assets Fund is, as expected, a picture of extreme conservatism and stability, its heavy reliance on US Treasury securities and repurchase agreements. Coupled with remarkably low expenses and a dollar net asset value, highlights its primary goal, preserving capital and maintaining liquidity. The fund is essentially designed for investors who prioritize safety above all else, and who want to park their money in a vehicle that earns a modest return without taking on significant risk. The key strengths are its security and cost. Effectiveness by investing almost exclusively in government-backed assets, it mitigates the credit risk inherent in corporate bonds or equities. The fee structure is also a major plus, ensuring that a large portion of the investment returns makes it back to the investors. However, with extreme safety comes limited upside. The fund's principal risk is not a sudden loss of capital, but rather that its returns will likely be modest, especially in periods of falling interest rates. Investors looking for significant capital appreciation will need to look elsewhere. Trees also the general market risk they mention while their holdings are safe. A severe economic downturn or a crisis of confidence in government debt could, in extreme scenarios, impact even these investments, though this is highly unlikely with US Treasuries. In conclusion, the NTAM Treasury Assets Fund lives up to its name. It is a dependable, low cost option for those prioritizing the safety of their principal, offering a predictable income stream in line with current short-term rates. It is not a growth fund and it doesn't pretend to be, but for what it aims to do, it does it extremely well. Alright, that is our deep dive into the NTAM Treasury Assets Fund's annual report. What's your take on such conservative investments? Does the focus on safety outweigh the potential for higher returns for you? Drop your thoughts in the comments below. If you found this analysis valuable, hit that like button, it really helps us out, and subscribe for more corporate breakdowns. And don't forget to join our Discord community linked in the description. Thanks for watching. And well, see you next time on Corporate Decoder.